Cleaver Media's Mining Weekly Online is talking to Bruce Cleaver, the Director of Strategy at De Beers, which has just brought out a new consumer report. Hi Bruce. This latest De Beers report tells of global diamond jewellery demand growing at an all-time high of $81 billion. Can you give us some insights into that and translate into carats that we're used to?
So we've just released some data which reflects our view on global diamond jewellery demand and diamond jewellery growth in the 2014 year. And remember, of course, that all rough diamonds that get mined get turned into polished diamonds and then into set jewellery pieces, and that is what consumers buy. The good news is that in all our main markets, diamond jewellery growth continues, so there's been good growth in all our main markets, at least in local currency terms. So what that tells us is that there still remains good, healthy demand for diamond jewellery pieces. And Martin, here I'm talking about diamond jewellery pieces that are set in jewellery for consumers, rings, earrings, necklaces, etc. If we break that down a bit, our biggest market by far remains the US, and it's grown very nicely, as I think we all know. It grew at about 7% in terms of diamond jewellery growth last year. That's very healthy. That reflects the US economy's continuing recovery, perhaps a little bit of benefit from a lower oil price. We know jobs are coming back into the US. So our main market is actually in nice, good shape, good solid shape. Our next biggest market is China. That also grew very well in 2014, probably a little less than the heady days of 2012 and 2013, but still very good growth. So China grew, we feel, about 5%. And obviously the base that China's growing off every year is getting bigger. India's the third biggest market. That also grew. It grew in local currency terms about 3%, but you'll be aware the rupee was quite weak against the dollar in the course of 2014. So in dollar terms, that growth number was slightly negative. And our other two big markets, Japan actually also grew in local currency terms, but the yen suffered tremendously against the dollar, so it declined slightly in dollar terms. And the Gulf's a big market, and that also grew nicely. So in total, when we total all that up, we see total diamond jewellery sales of about $81 billion US. That's 3% up on 2013, and reflects the story that we continue to tell, which is that there's good, healthy consumer demand out there for diamond jewellery in the end product, and that obviously reflects well back into the rough diamonds that we mine and sell.
And talking about reflecting back into the rough prices seem to have a bit of a decline towards the end of the year. What was that all about?
So that's also correct. Rough prices in the beginning of 2014 grew quite nicely. As did polished prices. Obviously rough prices and polished prices do work to some extent in tandem. In the second half of 2014, we saw a little bit of a softening in the rough markets. Polished prices started to decline a little bit. Rough prices often follow that. We put that down to a couple of things. I think the Chinese growth has slowed down a little bit. As I say, nothing catastrophic. Growth continues to be good, but not the heady days of before. You may have heard talk of liquidity issues in the midstream. So we know that the midstream, those are the people who cut and polish diamonds, have experienced a few liquidity issues. None of these are particularly catastrophic, as I say, but made the second half of the year a little bit more difficult than the first. And the last point on that was interesting was that at the end of 2014, the US Christmas season was slightly slower than we'd thought. Not massively so, and again, not a particular worry, but slightly slower. China was a bit slower in the fourth quarter of 2014. You'll know about the Hong Kong protests, for example. That meant that there were less people in stores buying diamonds. So towards the end of 2014, the markets were slightly slower than we had hoped. We do think that in 2015, though, that there's a good positive outlook for diamonds. We think the two markets that will probably be the most robust will be the US, still, as I said earlier, our biggest market. So that's still very encouraging. We think India is recovering quite nicely. Inflation is down, interest rates have been cut. The impact of the lower oil price is positive, so we would expect India to grow nicely. And as I said, on China, although it has slowed down a bit, and there's no doubt about that, the growth rates are still healthy. So for 2015, we would again expect a reasonably positive year for diamond jewellery, and therefore for rough producers and sellers.
And are banks coming to the party with the funding for rough?
So the issue of rough funding has been around for a long time, so this is not a particularly new issue. There are a number of banks that fund the midstream. The main cutting centres, obviously India by far the biggest, Botswana, South Africa, Namibia, Israel, places like that. It's no secret that bank debt there's been under a bit of pressure over the years. We've heard that one of the banks, ADB, is likely to be closing. But it's being closed, which is a diamond lending bank, in an orderly fashion, and the book will be run down in an orderly fashion. So I think it's fair to say liquidity has been a little difficult in the midstream. That's been made a little bit worse by the slightly slower Christmas sales. What that means is stock moves a little slower, and therefore cash comes into the retailers and then finds its way down the value chain to the cutting centres a little slower. But provided 2015 remains a solid year, you'll see that working its way out of the system and liquidity coming back into the system. So it is an issue, and it's something that we do worry about, but we do think it's manageable.
And what is the outlook for the price of rough diamonds? What can we expect?
Yeah, so we don't, as you would expect, give outlooks on price in particular from a year-to-year or a site-to-site basis, I think for obvious reasons. But what we do say is if you look at all the fundamentals, both in the longer term and the medium term, where we often talk about the fact that the growth in demand will exceed the growth in supply, which is very positive. And as I say, when we look at the shorter term, 2015, we think the main markets will do reasonably well. That should have, over the year, a reasonably positive impact on rough prices. It depends, of course, on polished prices moving. It depends on the next selling seasons being positive. Early signs of Valentine's Day in the US are quite positive. Early signs of Chinese New Year in China are quite positive. So we're hopeful there will be some rough price movement in 2015.
So it's wonderful to see a supply gap in some of the commodities. I mean, we can see most of the commodities are afflicted by oversupply. The exception is the diamond industry. Is this gap widening or closing?
That's a great question, and we spend a lot of time thinking about that, as you would expect. Firstly, it's important that I just reiterate what we say and what we model is when we look at the growth in consumer demand, based on all we know about consumers' behavior patterns in the economies in which we sell, and we model that against the growth in supply, we see a difference. What that just tells us is that at a higher level is this remains an attractive industry. What's also very attractive about this industry is perhaps unlike some of the other ones you're talking about, is there is not a significant amount of what we would call marginal production which could come on stream if prices rose. So we don't have the risk if prices went up a reasonable amount or a significant amount that all of a sudden a whole lot of new production would come on and change that analysis. Very hard to find major new diamond mines in exploration. We know about all the major projects out there. We model them in our model, and what that tells us at the end of the day is that there's not a big supply crunch coming where there's too much supply, if you like. As to how that gap gets filled, it's a combination of things like technology and price and retailers being smarter and margins being increased and yield out of rough to polished getting better. So there's a number of things that could fill it. But that's the reason we're so enthusiastic about the diamond industry is structurally we see benefit for producers going forward because of this supply-demand issue.
And where does Southern Africa, South Africa in particular, fit into all this?
So Southern Africa in particular is one of the major diamond producing parts of the world, as you know, and South Africa is a major part of that. South Africa, of course, is where it all started, back in Kimberley in the 1880s. In Southern Africa, Botswana is a considerably bigger producer than South Africa, but South Africa is the second biggest producer in Southern Africa and will remain a very, very important part in the production world, not just for De Beers, but for the world. You'll know, I'm sure, about our project at Venetia, where we are extending Venetia by going underground, taking the biggest mine in South Africa, the biggest mine by some way underground, extending the life to beyond 2040, another 94 odd million carats underground. So we are excited not only about the future of the diamond business, but about the future of the diamond business in South Africa, and we're very committed as De Beers to South Africa. And
could Southern Africa be eclipsed by other activities? We look at Canada, a lot of reports coming out of Canada. What is the sort of comparison between the other world supply and Southern Africa and South Africa?
So a really good question. The main areas for production really are, as I say, the Southern African node, Central Africa, which is Angola and the DRC, Russia, which is a big producer, and Canada. As I say, Botswana is the biggest single producing nation, Russia the second biggest, and South Africa is one of the nations that comes just after that. Canada has produced a fair amount of diamond mines over the years, but has never found a sort of a mega mine of the scale that materially would move the dial. And Venetia is one of the great mines of the world. There's absolutely no doubt, and will continue to be an important mine for us. So South Africa is a big player in this, and will always be, we think. And we think it's prospective from an exploration point of view. We spend a lot of money exploring in South Africa. So it's not just about mining the existing mines. We think we are very hopeful of finding another mine in South Africa as we keep exploring here.
And Russia has come under a bit of sanction pressure. Diamonds haven't been affected in that. Do you think diamonds will escape sanctions, Russian sanctions?
So we spend a lot of time thinking about that, actually. So far, the sanctions, as you know, in Russia have been rather targeted against individuals and not against industries. And we spend a lot of time explaining to people that the unintended consequences of sanctions on an industry could be significant, because you wouldn't want an impact of sanctions on any of the other producer countries. It really would depend on what sanctions were and how they looked before I could really tell you if they would have an impact. What I can say is that up until now we have seen an understanding of that amongst the regulatory folks, and an understanding that the sanctions are really, as I say, targeted at key individuals rather than industries. So it's something we monitor and continue to engage with the regulatory folks around the world on, but for now isn't of a particular concern.
That was Bruce Cleaver, the Director of Strategy at De Beers, talking to Creamer Media's Mining Weekly Online on the $81 billion that the world spent on diamond jewelry in 2014.